Welcome to the Data in the AI Era podcast. I'm Peter Finter, and there's a series I sit down with data leaders from the financial services industry to explore how they unlock the full potential of their data amidst the challenges and opportunities in the AI era. And today we're diving into a moment that every quant, every data scientist, or really anyone who's building models has faced. You've built what you think is a solid data pipeline. You've got clean data, a proven algorithm, and you've tuned the parameters just right. But when you run the model, the signal's flat. The predictions are not impactful. And you're left staring at your screen thinking, what on earth is going wrong? We've all had that feeling. And our guest today, Judith Gu, has faced that same moment in real time, low latency trading, risk management. And her discovery process may be helpful. I hope it'll be helpful to you to help us think about our data, our infrastructure, and what makes models actually work. So, Judith, welcome to the show. Thank you so much for guesting with us today. I wonder if you could start by telling us a little bit about your background and why this particular topic feels so relevant right now.
Thank you so much, Peter, and thanks for inviting me to this podcast, so relevant to the quant community. Yeah, so I lead the equities and EFX quant trading strategies at Scotiabank, where we focus on automated market making and real-time risk management. So there are primarily two types of risks: systemic risk or beta risk, or idiosyncratic risk, or we call it alpha risk. Where systemic risk or beta risk is usually optimized through a risk model, idiosyncratic or alpha risk needs to be understood, analyzed, and predicted through data and predictive model. And we call this discovery process the quant research. However, we need to be mindful that quant research needs to lead to commercial results. We can't always just stay in the research land. We, the results can be either explanatory power, explaining why the P&L risk behaved a certain ways, or prediction accuracy. And when models don't work, we need to make a right and fast decision of whether we should just keep digging or moving on. And the decision to move on is actually not easy because we don't have infinite amount of opportunities or data sets. And yet the problems stay with us. They're real and persistent. So we usually keep digging. But what are the effective ways of digging after we already built a reasonable data pipeline and model? And that's the focus of the conversation.
I'm really looking forward to getting into it, Judith. And I know that a lot of your earlier work was in equities, but more recently, you've been more focused on FX and specifically on high frequency environments. So I'm wondering, before we get into the modeling aspects, could you just set the scene for us a little bit? What was this shift like, moving from equities to FX, two very different worlds?
Yeah, so before moving to FX, I was told and I heard that equities and FX trade alike. But after getting into the space for some time, I definitely don't think they're twins. I think they're at most cousins, to use an analogy. So FX trade a lot more. How much more? 15 times more than equities. It executes $7 trillion a day, 24 hours and 5 days a week. And equities trades a few hundred billion a day, 6.5 hours and 5 days a week. FX orders are executed rapidly, usually in milliseconds. And FX is driven by macro news, central bank policies, and geopolitical risk. And the markets react in millisecond frequency. And equities have concentrated trading burst, especially on open and close. But equities have fundamental stories. Equities velocity is more fragmented, different exchanges, tickers, and liquidity profiles. And corporate news and earnings cycle are also driven the volume and velocity of equities. But FX definitely have higher velocity in terms of both volume per hour and execution frequency because of its global and continuous nature. And equities, when it's fast on their own, they're constrained by exchange and fragmented liquidity. Because of this much higher velocity in FX, some of the slower moving intraday feature, which I thought was high frequency and low latency for equities, they're not applicable to, they don't work well for FX. And this compressed time frame really changed everything. from latency to impactful features to what counts as signal between the two.
I think it is. It's always so interesting, isn't it, to come into a new space. You bring with you your experience and expertise, and you start to apply the tools and techniques that you're familiar with, and you're testing to see, do they resonate, do they fit? What is it about it that is surprisingly different from what I thought? What were the first things that really struck you? You've highlighted some of the characteristics right there, but as you started to apply your approaches, what were the things that maybe were the biggest surprises for you as you made this transition?
Yeah, so the biggest surprise is some of the feature-driven model in equities, they don't work well for FX in such
Mm,
low latency and high frequency space. So a lot of times in equities, we think, okay, is something priced in, or the future is having a bigger impact because it has causal relationship in for the stock.
mm,
It's fundamental to the real time moves. Those those features and hypothesis may not work as well for FX because FX is so macro driven. It doesn't have a fundamental stories to each of the currencies. The fundamental is really the macro news, and it really the market reacts on
mm,
a dime. So the what surprised me the most is only because of the speed and velocity, we have to rethink how we build the models. What's important? What actually works? A
mm,
lot of times,
mm.
something may sound like they're going to work, but because of the frequency space we're trading in, we're in a higher frequency and lower latency, not medium frequency space, those approaches don't apply well.
So let's position ourselves. Let's follow the journey that you went on, Judith, because I think that's gonna illuminate a lot of very interesting perspectives for everybody on the call today. So you're in this new, faster moving FX space. You're doing all the right things, at least what intuitively should have worked, but the models are proving not to be better than the naive model. And I imagine at that point, the natural instinct is to say, maybe I just need a better model. Was that your first thought?
Absolutely. So we usually start with a naive model and then incrementally dial up the complexity to test if there is
Mm,
improvement in prediction. So given the high frequency nature, the naive model is usually refers to the prediction the next price point is the same as the current price point. So the
mm,
naive model reflects ideas that price changes not predictable, better than just follow the last one. And it sets the bar for any predictive model that must outperform to be worthwhile.
mm,
So when the model is not delivering, the early and initial reaction is the model's underfitting. So we
mm,
increase the complexity in the nonlinearity ladder from linear model to machine learning model to deep learning. The idea is to capture the potential nonlinearity that might be underfitting in the simpler models, and along the way, iterating through hyperparameter tunings to make sure there's no overfitting either. So in addition, iterating feature importance analysis after all those iterations fail to make a difference or a material difference, I said to myself, there could be only two reasons: the raw input data and or the model. But since all the different models on different spectrums, they all had the same results. So my
mm.
focus was turned back to the data.
And isn't that interesting? Because I think our natural tendency is to assume, as data scientists, that it's always going to be about the model. If we have some degree of confidence that the data is presenting in an appropriate way, we're always going to want to go and dig deeper on the modeling side. How did you decide when enough was enough? Because that was one of your opening comments, which was around the choices we get to make. Our time is limited. We have to make careful choices here. And often our tendency is to say, I'll just keep digging. There must be value in here somewhere. When did you say, enough was enough? I'm going to go back to the data and ask that question. And the reason I'm asking you that, Judith, is because one of our earlier guests, Erin Stanton over at Virtue Financial, was telling us that she had worked with a data set for over 2 years before she came to understand where the weakness in the underlying data was and realized that that was the key to unlock the solution that she needed. So tell us more, Judith. How did you get to a point of saying, okay, I've given it my all. I'm gonna accept that it must be somewhere else.
Yeah, so it's a great question and great point of sometimes the data issue can be so subtle it really escapes the human eyes. So, and human intuition and domain knowledge as well is possible. So the point I said, let me go back to data, is when I looked at the returns, they're just hovering around the average across all models. So I'm saying it's either across all models, linear model, machine learning model, deep learning, ARIMA, EGOCH. EGOCH is for volatility, so that's a different story, but ARIMA model for the returns stay the same. So that's the point I said. It's either the return is actually not predictable, doesn't have the structure, which is odd to me. Like intuitively, it's odd, weird to me, because how can the structure change so much if it's continuously trading? But that has to be an area of interest to study. That was the time where I turned back to data, because going through all those models and thinking, incorporating all the features that making sense, and a lot of them, and the return prediction stayed as average. Because if we stayed as average, we there's no point for quant researchers to persist and saying it's better we should do models than just calculating the average, right?
Of
Calculating the
course.
average is so simple. We shouldn't
We could save a lot of time.
just we save a lot of time. Yes. So that's the moment I said, okay, let me go back and check the data if it's actually having the structure and predictable.
So that is the fundamental underlying question, isn't it? Because you were looking at model selection, you were looking at parameter tuning, but you realized there was something underneath of that. The question really was, is the data itself even predictable at all? Which is a pretty fundamental question. And it changed a lot of things by virtue of what you discovered next. Can you just walk us through that moment?
Yeah, so once I shifted back to model shifted back to data from the hyper iterations of models and parameters, I start questioning if the return data in such high frequency condition has a structure. My default answer is it should, because it trades continuously. How come the last data point doesn't influence the future data point? But to my amazement, in a way, also to my relief, the confirmation came back from a set of statistical testing on autocorrelation. It verified the return series, the raw return series on its own is indeed white noise. So there's no autocorrelation structure with any reasonable lagging order can ascertain there's a pattern in the time series of the return, of the raw return. On the other hand, I did find volatility does confirm it has a structure, and it also coincides with the model results. And volatility has some predictable, good prediction results, even with this EGOCH model, even without the machine learning or deep learning. So that was a revelation. I said,
That's
oh,
a big finding, and I mean, it came
it
as
was a big finding.
it came. It
Yeah.
sounded like that came as a surprise to you. Is that how it
It
felt?
was definitely surprised at the moment,
Yeah.
at the moment when I saw it, because we always think volatility is a result of returns. Isn't that just a standard deviation returns? But looking into more in the FX trading space, there could be different reasons that seemingly confusing the divergence between return and volatility. And there is mainly from two sources. One is market microstructure effects. So at such high frequency, there's bid-ask bounce, order flow, or liquidity imbalance. They all inject noise into returns. And yet the same element is creating volatility. So at the same time, when it's injecting noise to returns, it creates the signal of volatility. Those the microstructure effects, and also information arrival. When price reacts instantaneously to new information, makes returns hard to predict. The intensity and frequency of information flow can be forecasted, and that drives volatility. So the microstructure that can making the return space more chaotic and non-structured at the same time, it actually makes volatility space more clustered and more structured.
It's pretty
So
confusing. Yeah.
it's confusing, but also it makes me look deeper into why the divergence happens and what's the reason for two different behavior as well.
What at a macro level, what I'm sort of sensing here is that we're always looking for signal in the noise, and to be able to separate those two things out can be very challenging when we see different interactions occurring here. I can imagine that what you felt at this point in time was a mixture of emotions, because on the one hand, there was some explanation for the phenomena that you were observing, and you were starting to sort of piece that together. But at the same time, it sounds like it was probably a bit disheartening because you were realizing that the return data didn't really have any structure that you could model. Um, so where did you go from there? Because one can imagine there's a sort of a little revelation that says, I'm on a path here, something's happening, this is good, I'm getting somewhere. On the other hand, it wasn't really aligned to where you were expecting to go. And that's usually a point where we ask ourselves, do I know what I'm doing? Do I have the tools at my disposal? How did you navigate that next step? Did you yeah, just let's try that. What happened next?
Yeah, sure, absolutely. That's definitely describing my journey. So after confirming return is white noise and yet volatility has a structure, there are only two choices. Give up on return prediction and modeling and just
Hmm.
only model volatility, or keep digging on what else can be done for returns. So volatility model is useful and important, but we've done that. There's a lot of that out there as well,
Mhm.
and on its own doesn't help us a lot. Without the direction, just knowing the magnitude, cluster the magnitude helps, but it doesn't help us for the next level we need to go. And if we can predict returns with a direction, a more better than random walk, it's going to help us a lot more than just having a volatility model.
Yeah.
So I decided to keep looking in return what else can be done. So the next idea is definitely smoothing the return to take out the outliers and noise around it and see if the smooth curve is helpful. And we went through a couple very usual methodologies like moving average and exponential moving average. It did help, but it didn't help on the material level that
Mm.
it will make a material difference. So then I learned about, I read about this in literature, that high frequency time series resemble noisy signals, especially in like micro structural space, such as bit-ask bounce,
Mm.
latency arbitrage, or order flow noise. And this makes the signal more behave like electronic or radio signals as
Mm.
opposed to finance signals. That was like another
That's a great analogy.
light bulb. Yeah, another
Yes.
light bulb. Like, okay, we're looking at a different frequency space. That became the inspiration to run wavelet denoising high frequency raw data. Again, it's definitely not my discovery. It was actually in financial literatures. Many places did apply
Mm.
wavelet denoising to high frequency signals data, such as FX and even equities. So on a very high level, wavelet denoising separates data into approximation and detail levels, when the detail levels are likely the noise. So the
Mhm.
detail levels then go through a frequency filtering process. And the post-filtered detail level and approximation, which is the low frequency layer, are reconstructed back to denoised data. So it touches the levels that has high frequency, higher noise level, and filter on those levels, and then reconstruct it back to the denoise time series. So take a step back. I think quite often we do go back to data and features when model doesn't meet expectation. We do go through the iterations, but often we left the level of checking is the raw data accurate, confirm
Mm.
stationarities and more feature engineerings, less thinking about a questioning if the data itself has prediction power, which is definitely the case for myself in the very beginning.
Yeah.
And I think even more intuitively, data like price and returns are so basic to the model, we should still question those assumptions.
I think it's so fascinating, and I'm so glad that you introduced that idea of sort of like radio signals, because what went through my mind was a couple of different things. The first is, back in the day when everyone had hi-fi systems, you had these equalizers where you could selectively reduce or increase the contribution from each frequency range into the sound that you were hearing. And what I interpret what you just said is that you found a way using wavelet denoisers to essentially tune down the high frequency data that was generating a lot of noise that was masking the underlying features of the data that you wanted to expose, but you were able to then recreate that signal in such a way that it could then be utilized effectively for modeling purposes. That's a pretty interesting approach. Was this the first time in your career that you've applied that approach, Judith, or is that something that you had in your back pocket from other experiences that you were able to bring forwards? How new a technique is this in reality?
Yeah, in my experience, it's actually a new one. It's the first time I apply wavelet denoiser in the time series.
Exciting.
Previous, yeah, it was exciting to me. It's also a great learning experience. Previously, the smoothing techniques are usually moving average and rolling windows, which is quite common in equities field. So, but actually applying an engineering frequent, like turning from time series space to frequency space, is a first time experience for myself, and it was a quite eye opener for me as well.
It's a shift, isn't it? I think this is one of the things that's coming across to me is that this was all prompted from a move from equities to FX. It reframed the way you thought about data and what you were seeing in the data, and it seems like it gave you the inspiration to identify or seek new techniques to apply to solve the problem differently. And I think that's always, the sign of a truly creative problem solver is not to be satisfied with the toolbox, but to be seeking constantly to find that new tool that's going to help us address a new situation. And I was just thinking about the way that you described your journey. That's a pretty big shift in your thinking and in your approach. But I recognize that there might even have been more to it than you've just described to us, because it wasn't just about how the data was behaving. It was also about how it was being represented to the model. And I wondered what made you think differently about feature construction as a result.
Yeah, so there's definitely more than just to the return data in the model construction and its thought process, because there are other features in the space as well. What we want to do is to model as much as possible the trading environment as well,
Mm,
not just the data itself, but what else is going on when the data is streaming in. So there's a couple other features that's very even more prominent to FX space, such as trading sessions. Because it's trades continuously 24 hours. There are trading sessions a lot more liquid than the other trading sessions,
yeah.
such as London, New York crossover, and then Asia hours. So
Mhm.
that we want that to be a feature into the model as well, and then trading hours as well. The 24-hour has different volatility, liquidity, news flow for sure. So we want to have features like trading hour into the model as well. So we
Mm.
want to not just have the continuous numerical features, but also the categorical features that's describing the environment as part of the model. And to use categorical features is actually quite different from numerical features, such as hours, trading hours. It's from 0 to 23. And 0 to
Mm.
23, if we just passing as 0 to 23, it might mislead the model because there's a huge difference between 0 and 23, but they're actually next to each other on the clock. So we want to reconstruct the feature as a circular feature. And there are ways there are techniques of doing so. But just be aware that those are the
Mm.
differences, and we need to construct them correctly as opposed to misleading the model as a numerical feature is very important.
We talk a lot about temporal considerations, time awareness, contextualization
Mhm.
around time. We talk about it a lot because we are so focused on time series data. I think you're just giving us some really great examples as to why it's so crucial to understand what time means. It's not just a
Yeah.
numerical feature. As you just pointed out, we have to understand that there are behavioral kind of characteristics which come as a result of where in time or when in time something has occurred. And it's good to remind ourselves that there are tools that allow us to apply that insight into our
Yeah.
models and take advantage of that. Well, Judith, to take a bit of a step back, because this has been an amazing journey that you've just described, to start from rather confusing results resulting from, no matter what you tried, things were not working out as planned, to be able to stand back from that and say, it really must be a data problem, not a model problem, and then rebuild the model, having cleaned the data to bring it all the way back to something that was then useful on a go forward basis. That's a tremendous achievement. I wonder, as you reflect on that and thinking about all of our colleagues on the call today who are listening to the podcast now and thinking about their own frustrations and challenges that they're facing, what stands out to you on the process, and how does that apply to the way you're going to approach the next challenging problem that you face with your data and your models?
Yeah, I think definitely keep an open mind. So as
Mm,
a quant researcher, I know we use the phrase every day, right? Keep an open mind. But what it really means when it really applied to us on such a detailed level is another mind opener to me for this process. So I think as a quant researcher, we live and breathe all the details. We usually
mm,
pride ourselves in our domain knowledge because we keep iterating the details and we keep absorbing what we see in the market. We think we have high convictions. Otherwise, which is all good qualities for a quant researcher, because if you don't have high convictions on what you do, um, then it's a problem to begin with. So, however, we have high convictions on what data should be used and how features should be engineered, what model should be applied, and what parameters are reasonable.
mm,
We're
mhm,
we have lots of confidence in ourselves, which I think they are still good qualities. However, when model fail to deliver or doesn't give you more information above the beside the mean, away from the average, so instead of being so convinced that it's not me, right? It's something else. It's a model. It's something else. It's not because of my limited experience might have constraints or limitation on myself. We're also blessed with the power to go back to question our assumptions about the thesis, about everything, about
mm.
thesis, the data, the features, not just the obvious ones, but also the hidden ones. I think that's something to always keep in mind, to for us to be able to handle better with surprises when things we think is just so making sense and natural flow, and we should just get it right, and we have insights, and it turn out to be not so. Let's just have an open mind and question our assumptions,
That is such a
even when
great.
we're highly convinced.
I think you're so right, and we can take these sort of words sometimes almost too superficially. Actually, it requires a behavior, it requires a response, it requires an action from us. If we're going to keep an open mind, what does that really mean in practice? And what I love about the way you described your story is that you were operating from first principles. You were applying all the expertise and experience you have, but at the same time, you were also seeking for new ideas to bring into the solution. And the research that you uncovered, which was it sounded like that was relatively new to you, a new tool, a new technique. I think the ability to tap into the intellects of others around us, either through research or through direct interaction, is partly what we want to inspire in the KX community. The reason that we bring ourselves together like this is so that we can share these ideas. And I really appreciate you taking the time to do that, Judith. Your willingness to challenge assumptions, not just about the model, but the underlying data. I think that's something we all need to be doing on an ongoing basis. And it is easy for us to make models more and more complex. We can change parameters. We can add, we can make them more sophisticated, but we sometimes just have to step back and ask the fundamental question: is this data even telling me something meaningful? And How can we make that apparent? And one reason we call this podcast series Data in the AI Era, because we recognize that AI is dependent and machine learning is dependent on the underlying data, and getting that right and understanding that is something which I think is going to continue to, to bring rich rewards to those pioneers in the quant research space who are willing to pursue those golden nuggets, if you will. And ultimately, back to alpha at the very beginning, it hinges on our ability to see something that others aren't seeing. And staying ahead of the game is what we desire to do and desire to support you to do, Judith, as we move forwards. So thank you so much for joining us today. It's been an absolute pleasure having you with us. You shared some fantastic insights. I can't wait to have you back in a few more months when you've had a chance to tackle the next major problem. And I want to extend an invitation to everyone who's listening to this particular podcast to say, if you've got something that you've been working on, something that's been stumping you, bring that problem to the podcast. We'd love to share it, get other people's insights into that. And if you've broken through in any particular arena that we've been talking about, again, please come share that with our community, with your colleagues around the world. See, let's make this better for everybody. And we can all get something from it. So thank you. If you want to pursue and follow up on what we're doing here at KX, I invite you to come to kx.com. If you've got any suggested topics or things you'd love to suggest for future, just email us at podcast@kx.com. Thank you so much for joining us today. Thank you for listening in. And we really look forward to having you join us next time. Thanks.